Hey, what's good everyone, and welcome back to ETFs Explained. If you're new to the channel, my name is Jordan, and I am the mind behind MakeMoreCapital, the financial education brand that aims to make everyone a little bit more financially literate. And today we're going to be covering some real estate investment trust ETFs for Canadian investors that trade on the Toronto Stock Exchange. So these are ETFs that actually invest in real estate holding companies. So if you don't own any real estate yourself, don't have a property or a mortgage, this is a way that you can invest in a financial instrument that tracks or that actually invests in real estate. So it's a way to actually get more exposure and diversify your asset allocation outside of just equities. Although these are equity companies, they are invested in real estate though, so it does add some diversification to the portfolio. Now, if you missed any of the last videos, I did some real estate investment trust ETFs for American investors, so you can check that link out in the description. Also, if you are new to the channel, please subscribe if you don't want to miss any more ETF explanations. I do cover a wide variety of ETFs from US to Canadian ones. But also, yeah, make sure you subscribe, and if you enjoy this video on the way through, make sure you leave a like. Really helps out my channel, and I appreciate it a lot. That being said, if you are a Canadian investor and you've yet to open your self-directed tax-free savings account, there is a link down there as well, and if you use that to sign up, you get free money, simply just using that link, so might as well. And then you can always reach out to me and I'll help you navigate the platform and get you set up and let you know the right education that you need in order to buy and sell ETF shares for the long run and just become more comfortable using it. So without further ado, let's jump into the ETFs. The three that we're going to cover today, and again, these are ETFs that trade on the TSX. So they are ETFs that Canadians can buy with their Canadian dollars through, like, for example, their self-directed TFSA, and invest in Canada. So the FTSE Canadian Capped REIT Index ETF is VRE from Vanguard. This is the first one we're going to cover. Then we have the iShares S&P TSX Capped REIT Index ETF from BlackRock. And then I'm actually going to cover this one individual company that I own shares in myself, which is RioCan Real Estate Investment Trust. So just to give you an idea, RioCan Real Estate Investment Trust is a single company. They are a holding company that's invested in many different real estate projects. And so just for context, these are ETFs that inside of them hold many different real estate investment trusts. So as we go through this video, I will kind of explain the difference between the two of them, the one with Vanguard and then the one with iShares, and then I'll do a third comparison with RioCan, the individual company, just to show you what you can expect by investing in an ETF with multiple real estate investment trusts, which does diversify your investment. However, there is a small fee for doing so, your management expense ratio, versus in finding one solid real estate investment trust that is diversified in different real estate properties and investing directly in them yourself. So without further ado, let's just jump through VRE today. Obviously the market is open as it is 1 in the afternoon while I'm doing this, but so $27.54 is the current price. But as you can see, again, remember folks, with everything that happened in March and how the world is kind of slowly chugging along and getting things going again, there has been a steep drop because, of course, if people are staying home, they're not going to work or their office buildings, then there is not as much of a demand for real estate. So that's why I just wanted to point that out, is that this is actually a fantastic opportunity to buy and get some exposure in the real estate market. For example, XRE has gone through the same thing, and RioCan as well. I ended up buying in, my average price, I believe it's $15.62. So I'm a little, like, the current share price is a little bit below my average one, but I've continuously been buying. I think I've gotten up to 180 shares now. But basically the opportunity I see is just to not be afraid, buy as many shares as I can now, and hopefully the market, the real estate market will rebound and we will find different uses for these office buildings, maybe turn them into residential. I think no matter what, all these properties that still have value in some sort of way will be used for something else. Now, nonetheless, I don't want to talk too much and just get sidetracked. So the FTSE Canadian Capped Real Estate REIT Index ETF, VRE, basically this seeks to track the performance of the FTSE Canada All-Cap Real Estate capped 25% index to the extent possible and before fees and expenses. So again, I mean, the whole point of each of these investment vehicles are pretty much the same. Obviously, this one is it's an individual company, so it's different, but these two will seek to track the benchmark index. That is the FTSE Canada All Cap Real Estate Cap 25% one. The iShares one probably tracks a different one. However, if you wanted to find out what this index was, you could simply plug this into Google and do a little bit more research there. Now, the three important things we need to look for in an ETF are the management expense ratio. So you want a low MER. The second thing is you want a fairly consistent and high average annual return over time. Anything over 7% is ideal because your money will compound faster. And the third is consistent dividends. So let's look out for those three things. The MER, which is the fee that you will pay, is 0.39%. So because it is a real estate investment trust and because these ETFs actually pay out dividends every single month, the fee is a little bit higher. So that is why you see this one at 0.39%, where other ETFs, like ETFs that track the S&P 500 index, will be much lower. That is just, again, the cost of entry because these asset management companies do have to ensure they're making some money themselves, but this is the best way for you to invest in, well, again, these are great ways for you to invest in these assets, but because they're passive, you keep a lot more money and the fees are significantly lower. So let's look through here quickly. Basically, the distribution yield from this ETF is 4.12%. So this one here, it says 4.17. So you can get an idea of if that's what you're going to be getting in dividends throughout the entire year, which is pretty good. That's simply just dividends by itself. And whatever performance the ETF manages to do, you will also have that added on as well. But the thing I like about these real estate investment trusts is that they pay dividends monthly. And that is something huge. So every single month, depending on how many shares you own, you will get 9 cents on average. I mean, this would have been per last unit, but you'll get paid for every single share that you own, and once you own enough shares, you can reinvest that and just have the drip set up automatically. And the great thing is it is eligible for the TFSA in Canada, so you can use your self-directed TFSA, cost you nothing to open it, cost you nothing to transfer your money in, cost you nothing to buy shares using Questrade, and you just basically build passive income doing this. It's fantastic. So let's take a look at its performance. Over the past, so again, let's start long term. Since inception, which is 2012, this ETF has returned 4.20%. So all in all, that's not very high. And again, if we subtract the 0.39% from that, you're actually only getting 3.81%. So it hasn't done great, but again, that is how this ETF has performed. So regardless, you are making some passive income, which is nice, and obviously getting paid dividends eventually will allow you to buy more shares automatically without having to do anything, and that's kind of the goal of long-term investing. But of course, you want to make sure that you're getting consistent average annual returns over time as well. So over 5 years, it's done 4.21. Over 3 years, it's done 0.83%. But of course, because of this year, if anything, it's a sale and it's an opportunity to buy in at a price that you wouldn't regularly be able to get. But unfortunately, it's difficult to do when you're looking at these numbers and you're just like, oh, that looks so bad. Chances are, though, it can't get a whole lot worse than it is. I mean, obviously, don't quote me on that. It can, but I'm just pointing that out. And then if we go through this, it turns out there are 16 real estate investment trusts inside this one ETF. So again, as an example, RioCan REIT is one ETF. Is one real estate investment trust. This ETF holds 16 different real estate investment trusts. And one thing I did want to point out, the market cap is 4.5 billion, but the price to earnings ratio is actually quite low at 14.1. So in a lot of other videos, when we're looking at the S&P 500 or the NASDAQ even, you'll see the price to earnings ratio at like 22, 25, almost 30. That means, and again, if the sweet spot is 10 to 20, that means that there's a lot of future growth baked into that current price already, so there's less room for it to go up and possibly more room for it to go down. So if we're looking at this PE ratio, we see it's at 14, this should signal to you that, based on the earnings of the underlying REITs and assets inside of this ETF, it's actually not trading at too much of a multiple of its earnings, only 14 as opposed to trading 20 times or 30 times the earnings. So this, to me, would ideally be saying, hey, Jordan, this is a good time that you want to potentially start buying shares because, again, the lower the PE, it represents potentially getting in at a sale. And industrial, so the diversification of this single ETF, we have industrial and office REITs, which is 21.7%. Residential REITs, so industrial and office would just be company properties where people are working, right? Office buildings. Residential REITs would be where people live. home property and real estate services, retail REITs again here. So this is shopping malls, things like that, real estate and holding development, and diversified REITs. So at least the good thing is that by investing in an ETF that tracks many real estate investment trusts, you are very diversified, which is good. And if we want to take a look at what is inside of this ETF, we have the Canadian Apartment Properties REIT, First Services Corp, RioCan REIT, which is actually this one, which is always nice to see. So the third largest holding the third largest is in RioCan, which is great. Allied Properties, Granite REIT, Choice Properties REIT, First Capital REIT, H&R REIT, many of these, but again, there's only 16 of them. So at least you do know you're diversified. So we've seen the MER at 0.39. We've seen the performance since inception at just 4.20%. The good thing is that the price to earnings ratio is quite low, so you're actually getting shares cheaper than you usually would. So let's take a look at the distributions. The thing is with real estate investment ETFs, real estate investment trust ETFs, sorry, it's a mouthful to say. The good thing is that these funds or these assets pay dividends monthly. So if you look here, you can see 6, 5, 4, 3, 2, 1. You're getting 9 cents every single month. So again, if you have 100 shares, that's 100 times 9 cents. But every single month that you get it, you're getting paid this dividends that you can eventually reinvest and set the drip up with. Now, of course, when times are good and there's more abundance, you are getting paid more per dividend payout. But again, 9 cents is, if we go back to 2018, getting paid 10 cents, it'll probably be 9 cents for a little while, but that is the gist of VRE. So hopefully you found that useful, so you can navigate through these fact sheets better, or these information sheets. Now, if we jump to XRE, the current price is $14.91. And this one as well, like many other REITs, because that's just the reality of when, people aren't going to work and everyone's working from home. People are going to be afraid of owning office buildings or these different, people are just reconsidering what they're going to be invested in. And ideally, though, again, if you're planning to hold long term, shouldn't scare you too far away. And why would you want to own XRE? Exposure to Canadian real estate income trusts, exposure to different types of REITs in a single fund, such as retail, again, malls, shops, residential, office, and industrial, and then receives monthly distributions. So this pretty much basically can tell you everything I'm going to explain in a very quick snippet. And this one instead follows the S&P TSX capped REIT index, as opposed to this all-cap real estate 25% index. Now the performance, how has this one done since inception? Let's just take a look to see. Inception is 2002, so XRE's been around for longer time. And since inception, though, it's actually done fairly well, 8.44%. So over the last 10 years, 6.19%, quite good. Over the last 5 years, 4.67, 3 years. And then, of course, this year has been very difficult. But out of our circumstances, out of our control. But again, this to me screams opportunity. Consider getting into this. And let's check out the dividends. So ideally, though, okay, so first thing we know out of the 3 things we need to look for, since inception, it has returned to 8.44%. So long term, it does get better than 7%, which is great. Let's check out the dividends. How has this done? So for whatever reason, which was great at the end of the year, December 30th, 2019, it paid out 22 cents per distribution. However, it seems like it consistently pays about 6 cents per dividend. So this is, again, another thing you want to consider. I apologize. I don't think I covered the price. But so one share of VRE is $27.36. And remember, with this ETF, you're getting about 9 cents per dividend. Well, with this one share is $14.91. So it's almost half the price of VRE. And instead of 9 cents, you're getting paid 6 cents. So obviously the dividend is lower, so you're going to get paid more with VRE. However, because the share price is also lower, you'll be able to buy more shares more quickly. And therefore, that 6 cents might not be as big of a deal when you realize that if you can get more shares, because ultimately more shares equals more dividends, that is what you want to ultimately have in an ETF. So I would consider that just because the price is lower, but I haven't gotten to the MER yet, which is the other most important thing. So we'll take a look at that. But again, so asset class, real estate, these are invested in equity companies that own real estate, though. I know that can get confusing, so try not to confuse myself or you folks either. But so this was created in 2002, so it's an ETF that's been around for a while. That's always a good sign, though. The longer it's been around, that just means it's sustained itself. It's performed well. The exchange that this trades on is on the TSX. The benchmark is the S&P TSX Capped REIT Index. And inside this one, you have 21 different holdings. So whereas VRE owns 16, has 16 REITs inside, this one has 21 REITs inside. And out of the characteristics, so good, we can set up the drip with Questrade, which is huge. It does pay dividends every single month, which is, again, massive, because every single month that you own this, you're getting paid money to own it. And the more shares you own, the more you get paid. And that's where the goal over 30 years is you can live off of those dividends because you can withdraw them from your TFSA tax-free, which is fantastic. And this one's huge. So the price to earnings ratio is at 7. So I would consider this absolute steal, considering the other price to earnings ratio. Now, the thing is, though, I do have to say that with REITs, the way cash flow works through REITs is a little bit different than earnings from companies. So, although I'm getting excited looking at that, you do have to consider the differences between, just equity ETFs and ETFs that invest in real estate investment trusts. But again, nonetheless, the reason why I still think considering the low price to earnings ratio is just because, with this 1 year, this is a significant opportunity to buy shares on sale, which you wouldn't have been able to had what happened this year not happened. So I would still consider that, though. Price to earnings ratio of 7 is extremely low, so that's something to like about this ETF. But okay, so then what is the fee? That's the other question, and it's 0.61%. So VRE is 0.39, and you're giving up about 22 cents more with this ETF. Now, again, it's not the end of the world, but that does matter because, again, ultimately, if you're getting 8.44%, you do have to subtract 0.61. So, you would, again, still be getting about 7.7% in returns, which is great. I do apologize, my math, especially when I'm on the spot, I can't do it that well. But, again, you are sacrificing a little bit more, and over time, the longer you hold this, those fees ultimately just add up. They compound as well, much like your earnings, much like everything else in life. So, keep that in mind, though. That is a high MER, a little bit too high for my liking. And they indicate this risk factor as medium, which is, that's definitely fair to say. So let's take a look at what's inside of this. But again, I do think if you can educate yourself enough to have the underlying knowledge of how the stock market works, you don't need to let this big drop scare you too much. Because again, look, we've seen a big drop before. What happens is we fix things and we keep going again, right? The big drop happens, we fix things, we keep going again. So that's just something I want to point out as well. I've only gotten to that understanding because of all the reading and the research I've done. But as you educate yourself on investing and you understand that, then it's not as difficult to buy when the price looks low, right? So let's take a look through here. Canadian Apartment Properties Real Estate ETF Trust, Allied Properties, RioCan again. Great to see RioCan number 3 on this list as well. Granite Real Estate, Choice Properties, Handra Real Estate. So this will have only showing 1 to 10, but there's 21 different ETFs in here, or real estate investment trusts in here, sorry. And if we look at this one, 30% of it is retail. So that would be shopping malls and a lot of stores that aren't actually open right now. But it's good to know that 27% is in residential ones, 17% is in industrial, so factories, manufacturing facilities, 11% is in offices. So again, these might not be used as much right now, but they are still going to be used, and going forward, they'll likely be repurposed, I would imagine. So that's something to consider. And then diversified REITs, healthcare REITs, I believe that would be in hospitals. Quite interesting to think that that's a thing that you can invest in, but most definitely is. And that's it for XRE as well. So as any investor, you would want to consider the average annual return over time subtracted by that MER, and then consider what you might get from the dividends. But again, I think it's nice to see that your dollar would go further buying shares of XRE. However, that the fee is a big thing for me, and that's ultimately why. And I'll share this all with you. Is why I bought RioCan, is because there is no fee for directly investing in a company. Right now, I don't want to just keep rambling too much, but I just want to show you a few things as to why I bought RioCan. But mainly the dividend distribution history. obviously, well, the other main reason I bought RioCan is because I'm Canadian. I live in Ottawa, but I've spent some time in Toronto, and I recognize this logo too. I've seen RioCan building some properties, so that obviously just gives me an understanding of like, okay, this company is familiar to me, and chances are that the idea of a company is just longevity over time and functioning sustainably. So it's just nice to see when I was looking at what they've done so far, and considering they've been around for a long time, I thought buying shares at this price was a steal in my opinion. Now, of course, we do want to look at the distribution history. And yeah, so it has paid dividends since 1998. And if you look, not every year, this doesn't go up every single year, but over time, they have consistently raised dividends from 95 cents up to $1.44. And because of this year, because of everything that's gone on, they have reduced it to 96 cents, which I didn't actually know that until now, so I'm going to actually have to do some research after this. But this, again, is just the example to give you context compared to the REIT ETFs versus an actual REIT itself. And then if you do look to see how they how have they broken it down? And even so, in 2020, though, they've still paid 12 cents per dividend. 2019, it was 12 cents a dividend. And I imagine quite similar in the past, but this was the main thing that I also looked for because I know RioCan, I've seen them around. And obviously the dividends are big, but what was the other thing? Let's check out their projects. Okay. Leasing, let's see their development projects. So they have a lot of expensive downtown properties in Toronto. They actually have this building in Ottawa, which is great. But the other thing too is that, I think a lot of these properties in downtown Toronto, Toronto's only going to get bigger. It's only going to bring in more people. Population is only going to grow. So these will find different uses. The other thing that I did read in their investor project was that, so let's see, top retailers. That's where we want to go. But I did read is that RioCan is going to be switching more to residential property as opposed to retail and office. So that was something that caught my eye. But again, I think Canada's only going to grow, which is great. But here, this was the last thing I wanted to show you. The biggest names in retail that RioCan rents their property out to are a lot of these retailers you might know. Bed Bath & Beyond, Best Buy, BMO, Canadian Tire, Dollarama, Costco, Cineplex, Oshkosh Bagosh, Gap, Good Life, gyms. So the thing is, they're quite diversified in their renter, or I guess the people that they rent out to, the people they lease. See, quite diversified. LCBO, Loblaws, like they have a variety of properties. So I just think no matter what, by focusing more of their attention and effort going forward into residential, all that's going to have them do is slowly eliminate some of these brands that they are already with, ones that don't necessarily need brick and mortar anymore, and shift all of that focus and cash flow probably into more residential, where again, people need homes, right? They will be living, so they will ultimately have a more reliable source of income than by sticking to owning massive real estate properties that, of course, when something like this happens, the global situation that we've gone through, no one knows how things are going to change, but it seems like what RioCan is planning to do is to adapt. So just as an example, if you had $1,000 to start with to open your Questrate account and you wanted to buy some VRE, $1,000 divided by the share price would get you 36 shares with a little bit of cash left over. And so that 36 shares times 9 cents, so let's see, 36 times 0.09 cents, this would mean that your first dividend payment would be $3.24. Now again, that sounds low, but that's just your first one. And over time, as you buy more shares, it will always go up. So even if you send 100 into your TFSA and you just buy 4 more shares or 3 more shares every month, that number is just going to go up over time. That's how investing long-term works. That's how compounding works. So $1,000 with XRE at $14.91 will get you 67 shares. And so example, 67 shares times 0.06 would get you to $4.02. So you are getting a little bit more than VRE. However, because that MER is a little bit higher, you might be losing a little bit to that. You do want to account the dividend yield, all of these little factors, but that is something you'll have to consider based on your own personal situation. And then just lastly, again, why I chose RioCan. Now the price is going up and down. Let's just say at $15.22 then. We'll use what the last price was. But at this price, you can get 65 shares. And 65 times 0.12 would get you $7.08. Now, I can let you know is that I bought RioCan, I think, last month, and I had 180 shares when they paid the dividend, and my dividend payout was roughly $15, which allowed me to buy another share with those dividends. So RioCan is an investment where I've invested enough money in there. Now I have 200 shares. But so like right now, 200 shares at the end of this month, I will get 0.12. I will get $24 in dividends. So that will again buy me another share of RioCan, and it will do that for the rest of my life. That is the amazing benefit of learning how to invest and becoming financially literate. So everyone, I hope you found that valuable, and please again reach out if you have any questions. I'm happy to answer you directly. You can email me through YouTube, comment. Obviously, comment below. Do you own any other real estate investment trusts? Was there any that I missed that you want me to cover? Please let me know. Otherwise, just let's start a discussion below. I always just want to help anyone else that does want to help or does want to get started investing. Otherwise, if you found this valuable, please make sure you leave a like. It really helps me out a lot, helps my channel. And if you can subscribe so that you don't miss any more ETF reviews, please do that. And I will catch you very soon for the next one. Thanks so much for tuning in, everyone. Have a great day.